All right, so from here to the end of our class, this wonderful class that we've enjoyed together this semester, we only got one topic left, that's leases. And so we're going to start by introducing, well, why do firms lease? What is a lease? And some basics, ideas behind leases. And then we'll get into the accounting, the different types, and then we're going to start actually talking about how they are accounted for, the journal entries, what's on the balance sheet, etc., all that stuff. And then we're going to get through a good portion of that today, and then next time, the majority of the time is going to be variations on the stuff that we do tonight. Because there's lots of potential different things that can happen with leases, and the accounting changes according to these different things that may happen with a particular lease. So first of all, if a firm is using an asset, they basically either they own it or they're leasing it. That's the only way you can be using an asset for something. And so if you don't own this asset, you must be leasing it from someone else. And depending on how you account for a particular lease, it may show up on the balance sheet or it may not show up on the balance sheet. And so for a particular type of lease called an operating lease, which we'll talk about, this is a means of what we call off-balance sheet financing. This basically is a way to have an asset that you're using as a firm that doesn't show up on the balance sheet. So a common example of this is looking at the airlines. So if you look at Delta's balance sheet, there's something missing from the balance sheet that you would think would be there. Airplanes. Delta doesn't own any airplanes. There are no airplanes on Delta's balance sheet, nor United, nor any other airlines. They don't own airplanes because they all lease their airplanes. None of them own their airplanes. And so this is a means of off-balance sheet financing, is having assets that you use that do not go on the balance sheet, and so there's also no liability associated with them going on your balance sheet either. Can avoid negatively affecting the debt-to-equity ratio and other mechanical indicators of riskiness. So if you think about the debt-to-equity ratio, essentially what off-balance sheet financing does for the types of leases, it takes the liabilities off. It looks like you have less debt, even though you really are responsible for making these payments associated with these leases, but you don't have to show that if you are having to get a particular treatment for your leases. Assumes the market is naive and is fooled by off-balance sheet financing. So firms, the only reason that they would want to not put these assets and liabilities on their balance sheet is if they think they're fooling someone. If you look at Delta's balance sheet, do you really think they're not using airplanes? No, we all know they're using airplanes, so anyone that knows anything about the industry is going to undo the off-balance sheet financing that they are doing. They're going to figure out the value of the airplanes and put them back on so they can actually do analysis of the firm. Otherwise, it doesn't make any sense. And so there is some evidence that managers believe that the market is fooled by this off-balance sheet financing. But there's also lots of evidence that anyone that knows anything about accounting undoes all the off-balance sheet financing that happens. So it's unclear why firms are currently using it, but they do.
Question.
Yes?
Is off-balance sheet financing just referring to capital?
Only operating leases, not capital leases. We'll get there in just a second.
Okay.
Yeah, we'll get there in just a second. Achieves operational objectives by facilitating asset acquisition to overcome. All right, so this is another reason why you might want to lease instead of buying an asset. There may be uncertainty or cash flow problems in your firm. So you're uncertain if you're going to continue in business. You're uncertain if you're going to have the cash flow available to make payments. And so you may lease something so that you don't have the responsibility in the future to have to make payments on something that you purchased or whatever else. So there are cash flow reasons why you might want to lease something. Time constraints and or control systems. So this is unfortunately a very common reason why firms lease things, is that within their organization, when you are a project manager or whatever and you're trying to use an asset, often the barrier to be able to lease something is much lower than to have the company buy something. And so this is a reason why many assets are leased instead of purchased, because of the control systems that are in place in various organizations. Time constraints, you need to get this asset quickly, you might want to lease it. Fear of obsolescence. So if you're concerned that this asset is going to go obsolete, you may want to lease it and then return it when you're done with it instead of buying it and get the effect of the decrease in value in the asset. These are all potential reasons why you want to lease. Achieves tax objectives. A lessee often can negotiate lower lease payments if it allows the lessor to retain ownership and thus benefit from depreciation deductions. When the lessee has little or no taxable income, it will get little benefit from the depreciation deductions, or the lessee has sufficient taxable income to take advantage of the depreciable deductions, but is in a lower tax bracket than the lessor. So there are some tax issues associated with leases, and whoever has the asset depreciates the asset and therefore will reduce their taxable earnings. And so there's the potential, if you are willing to allow the other person to keep the asset on their books, that there's a benefit to that for the other person. Yeah.
So you can take ownership of the asset when you lease it?
Okay, ownership, no. You get to use it, and depending on the accounting treatment, you may put the asset onto your books, or you may not. In one of the treatments, the lessee has it on their books, and the other treatment, the lessor has it on their books. And so there are tax issues that may make this more favorable in certain cases. All right, so now we'll get to some of the questions you guys are trying to ask. Well, what kind of leases are these, and what happens to the assets and such? So accounting by the lessor and the lessee. So here's a basic definition of the lease. A lease is an agreement in which the lessor is the owner of the property, conveys the right to use the property, plant, or equipment to the lessee, which is the user of the property. Associated with this is usually an agreement that the lessee is going to keep up the assets and maintain it according to whatever they would normally do, and that the lessor is going to get it back at the end in most cases. And the lessor is going to retain the ownership, the official legal ownership of the thing throughout the lease term. So the lessee is the user, and the lessor is the owner. A good way to remember that, the O of lessor and O of owner will help you remember those two. I still use that all the time to remember. So the lessee doesn't own the asset, the lessor does. The lessee is the one using it. All right, for the lessee, there are two potential accounting treatments. We have these two types. We have an operating lease and a capital lease. These are the two options. The lessor still has those same two, but the capital lease gets separated into two potential different types of capital leases. So for the lessor, they have three options: an operating lease, a direct financing capital lease, and a sales type capital lease. So for the lessee, there's only two options. For the lessor, there's three. And we'll go through all of those. So before we get too much farther, let me acknowledge that the lease rules are currently in limbo. The FASB and the ISB have been working furiously to come up with better lease standards. There's some issues with the way it currently works, and we're going to talk about some of those as we move forward. And so they are currently meeting, as in I think they met last week, the ISB and the FASB met together to try to work through some of the changes that they want to make to lease standards. And we're hoping here in the near future we're going to get some new lease standards. But this is the way it currently is here in the United States, and at the end of class next time we'll talk briefly about the way it works internationally. So the criteria for determining if this is an operating or capital lease is, have the risks and rewards been transferred? So in other words, who has the risks and rewards associated with the asset? Does the owner retain those risks and rewards, or does the person that's using it, the lessee, do they have the risks and rewards? If the owner retains the risks and rewards, it's a capital lease. If the lessee has the risks and rewards, it's I just said that completely backwards. Back up what I just said. If the owner retains the risks and rewards as an operating lease, because the lessee does not have the risks and rewards, If the lessee has them, then it's a capital lease. And so if it's an operating lease, that means that the owner retains the risks and rewards, therefore the lessee will not put the asset onto their books. And the owner will continue to have the asset on their books. If it's a capital lease, then we assume that the risks and rewards have transferred, and the lessee will put the asset and a liability, a matching liability, onto their books. And in most cases, the owner will take it off of their books. So this is how we determine, have the risks and rewards been transferred? And this is exactly what the standard says, and it's very specific. The rules are bright lines. It's either you're on this side of the line or that side of the line, and it has to be one or the other. And so this is the way we determine if something's a capital lease. A capital lease has a non-cancelable lease term, which pretty much every lease has a non-cancelable lease term, so that's obvious. And one or more of the following. If any one of these four things are true, it must be a capital lease. If all of these four things are not true, then it can be an operating lease. Okay, so the first one, if any of these things are true, it must be a capital lease. If none of them are true, then it can be an operating lease. So it's harder to be an operating lease, and generally things default into a capital lease. Incidentally, the treatment that everybody wants is the operating lease. So it's harder to get the treatment that everybody wants. The way the airlines have it, these are all operating leases. The owners, the people they're leasing from, have the assets on their books. Delta does not. That's an operating lease. And so, for them, these four things must not be true to get that treatment. The first one is the agreement specifies that ownership of the asset transfers to the lessee. So, at the end of the lease term, if the lessee gets the asset, it has to be a capital lease. The second one, the agreement contains a bargain purchase option. We'll have a definition of bargain purchase option on the next page, but the basic idea is if at the end of the lease term the lessee can buy the asset for significantly less than it's worth, that's a bargain purchase option, they're always going to do it, which means there's going to be a transfer of ownership, which it basically gets lumped back into the first one. Because if there's a bargain purchase option, they're always going to buy something for significantly less than it's worth, and so ownership will always transfer, and that's what we assume. So, no bargain purchase option, no transfer of ownership. The third one, the non-cancelable lease term, is equal to or set to 75% or more of the expected economic life of the asset. So let's say the economic life of an asset is 10 years. We have an airplane, that's a very short time for airplane. Let's say it's 10 years though. If the lease term is 8 years, it must be a capital lease. If it's 7 years, it can still be an operating lease, because the 75% is the line there. So if the lease term is less than 75% of the life of the asset, it can be an operating lease. If it's longer than that, it must be a capital lease, because this is saying that the risks and rewards are transferring, because they're basically using up all the value of the asset is the idea. And then the last one, and this is usually the hardest one to make sure is true, the present value of the minimum lease payments is equal to or greater than 90% of the fair value of the asset. So let's say we have this asset that's worth $1 million. If you take all of the lease payments, present value them back to today, add them up, that must be less than $900,000. If it's greater than $900,000, it must be a capital lease. If it's less, it can be an operating lease. So quite literally, firms will create their lease agreements such that the present value of the minimum lease payments is 89.9%. And I'm not kidding, that's exactly what happens. I had a friend that every year, one of his jobs in his firm was to make sure they were all at 89.9%. And they didn't go above that. And so it's exactly what happens. And so if all four of these things are not true, it can be an operating lease. If any of these four things are true, it must be a capital lease. And then for an operating lease, if it's not a capital lease, then it must be an operating lease. That's all that's left. Any questions on that classification process? We're going to add one thing to it here on the next page. We have a couple definitions first. A bargain purchase option gives the lessee the right to purchase the leased asset at a price significantly lower than the expected fair value of the property, and the exercise of the option appears reasonably assured. So basically, they're always going to do it. And so the reason that we have to have this bargain purchase option in the standard is that this is what firms were doing before this was part of the standard. They'd say, ownership doesn't transfer, but they're allowed to buy it at this significantly lower price. And so basically they had to add this to the standard to say, no, this does not get you around the rule. So bargain purchase options are still going to be capital leases. Lease term, normally considered to be the non-cancelable term of the lease plus any periods covered by bargain renewal options. So a bargain renewal option is basically at some point in the lease you're allowed to renew it at a significantly lower price. You're going to assume those are always going to be taken. And so those would then become part of the minimum lease term, or in the way we account for it, we call it part of the lease term. If the inception of the lease occurs during the last 25% of the asset's economic life, then we ignore that third bullet point. So in other words, if 75% of the asset has already been used up, then we ignore bullet point number 3 when we determine what it should be. All right, the classification for the lessor has the same classifications we just talked about, but with 2 new things we have to add. The 4 conditions discussed on the previous page apply to both the lessee and the lessor. However, the lessor must meet 2 additional conditions for the lease to be classified as either a direct financing or a sales type lease. In other words, to be a capital lease, we have some revenue recognition issues we have to deal with for the lessor. Specifically, if you're talking about a sales type lease, they're going to record revenue as soon as they sign the lease. And so to be able to record revenue, you have to make sure that you can record revenue. So you have to be pretty sure you're going to collect the cash and that you're going to have a profit on the deal and that you've done your work. And so that's where these 2 things come from revenue recognition. And so to be a capital lease for the lessor, the collectability of the lease payments must be reasonably predictable. You're pretty sure you're going to collect the cash. And if there's any cost to the lessor that have yet to be incurred, they're reasonably predictable. Basically, to make sure that you've done all of your work, and if there's any additional work to be done, you know you're still going to have a profit on this before you record revenue. So performance by the lessor is substantially completed. So these 2 additional criteria are just for the lessor to make sure they can record revenue. Does that make sense?
And then again, it's only with the capital lease.
Correct. If it's an operating lease, then they're great. You don't have to worry about that. Because there's no revenue to them when that happens. All right, now we're going to talk about an operating lease and do an example of it. We assume that the fundamental rights and responsibilities of ownership are retained by the lessor and that the lessee merely is using the asset temporarily. In other words, the risks and rewards associated with the asset have not transferred. So this is an operating lease. So none of those 4 things were true. Therefore, this is an operating lease. So a sale is not recorded by the lessor. A purchase is not recorded by the lessee. Instead, the periodic lease payments are accounted for merely as rent. Lessor records rent revenue, and the lessee records rent expense. And here's our example. And you should get used to this example because we adjust this example over and over throughout these lectures.